Hi, this is Lisa Busto from Harper College. This is Accounting 1, Chapter 10, review of Chapter 10 topics. This chapter focused on reporting and analyzing liabilities. Some of the key learning objectives are how to account for current liabilities, and we talked about how current is anything that is less than a year, generally speaking. The major characteristics of bonds. Bonds is key for this chapter. And also how liabilities are reported and analyzed. So first of all, what is a current liability? Current liability is a debt that a company expects to pay. A liability we've talked about is something that we owe from they expect to pay from existing current assets or through the creation of other current liabilities, and within 1 year of the operating cycle, whichever is longer, and it's generally less than 1 year. It's important to note what current liabilities include. They include notes payable. Notes payable could also be a long-term liability, or depending on when it's due, could be a current liability. Accounts payable are always a current liability. Unearned revenues, accrued liabilities such as taxes, wages and salaries, and interest. Notes payable, which it can be a current liability or a long-term liability. The distinguishing factor between a note payable and accounts payable is that a note payable is a written promissory note, and it usually requires the borrower to pay interest. It is frequently issued to meet short-term financing needs, and issued for varying periods of time from 3 months to 2 years, 3 years or more. Those due for payment within 1 year of the balance sheet date are classified as current liabilities. What's important to know about notes payable for this chapter is what the journal entry is, and some of this might be a review from previous chapters. Let's look at this first example. First National Bank agrees to lend $100,000 on September 1st, 2017 if Cole-Williams Company signs a $100,000 12% 4-month note maturing on January 1st. When a company issues an interest-bearing note, the amount of asset it receives generally equals the note's face value. So note that interest is always stated at an annual rate. But this is only a 4-month note. So if it starts in September, all of October, all of November, all of December. And remember, one thing with interest is earned over time. So our initial journal entry, we debit cash because we received the cash from First National Bank, we're Cole-Williams, credit notes payable. When we credit a liability account, we're increasing it. And then, if Cole-Williams prepares its financial statements annually and it makes an adjusting entry on December 31st to record or recognize that interest. So to calculate the interest, we look at the the calculation at the bottom of the screen. We take the principal times the annual interest rate, which they provided in the previous slide was 12%. But since we're only holding it for 4 months, we make it times 4/12, which gives us $4,000. Now the note must be payable on January 1st, and we go back to that matching principle and think of adjusting journal entries from the earlier chapters where and this is just an adjusting journal entry where one line item relates to the income statement and one line item relates to the balance sheet. So we're going to debit interest expense because it was over that period of time, and credit interest payable that we're going to pay after the first of the year. So for this chapter, we want to make sure that we understand the journal entries related to recording notes. And then when the interest is paid on January 1st, we would debit notes payable, decrease the liability, debit interest payable, and credit cash. Another topic from this chapter is sales tax payable. Sales taxes are generally a current liability, and the company holds on to that sales tax money to remit it usually to the state. So sales tax are expressed as a stated percentage of the sales price. So around our area, sales tax might be anywhere between 7 and 8%. The selling company collects tax from the customer and remits the collections to the state's Department of Revenue. So if we go to Woodfield Mall, go into one of the shops, and buy something in Woodfield, we pay sales tax. The store, let's say we're at Macy's, they charge us the sales tax, they hold on to that, and then remit that to the state of Illinois. So here's the journal entry. The March 25th cash register readings for Cooley Grocery shows sales of $100,000 and sales tax of $600. The tax rate is 6%. So to calculate the sales tax, we take 6% times 10,000. So they collected $10,600 cash. They credit or increase their sales revenue by $10,000 and credit sales tax payable for $600. This is a current liability that they're going to then remit to the state. Then, when it's due, usually on a monthly basis, they would say it's due April 15th. They would debit sales tax payable for $600 and credit cash. Okay, moving on. A big important topic in this chapter is bonds. Bonds are a form of interest-bearing notes payable. It's a way for corporations, municipalities, universities, government agencies to raise money. Bonds, here's a couple things to note about bonds. They're sold in small denominations, usually in multiples of 1,000. When a corporation issues bonds, they're borrowing money. The person who buys the bond is investing in bonds. So say, for example, Harper College wants to raise money for a building that they're building, and they don't want to go to a bank, they don't want to raise property taxes, because that's part of the revenue for how Harper gains revenue. Also, they don't want to raise tuition, so they're going to issue bonds. They are, in essence, borrowing money. And they work through an investment firm like a Fidelity or Edward Jones, who manages the bonds. There are different types of bonds. Make sure that you review the different types of bonds. There's secured and unsecured bonds. There's convertible and callable bonds. Make sure that you're familiar with this terminology. So let's talk about the issuing procedures for bonds. Understanding the bond terminology is very important. So the face value of a bond is the principal due at maturity. The maturity date is the date that the final payment is due. And remember, bonds are different from a traditional mortgage or a car note, where that big principal amount is paid at the very end, and then throughout the life of the bond, interest payments are made. Then we have the contractual interest rate, and that's the rate that is stated as an annual rate and how we calculate the interest payments that are going to be made. Interest payments are made either generally semi-annually or annually once a year. Here's an example of what a bond looks like. And remember, the issuer of the bond is the company or governmental agency or municipality who is borrowing money. It provides a maturity date when it needs to be paid back, and it's for $5,000. Here's the contractual rate of what we're going to use to calculate interest. So, what's very important from this chapter is that you know how to record the journal entries of bonds. Bonds can be issued at face value, below face value, which is a discount, and above face value, which is a premium. And bonds are talked about in increments of 100. So a bond at face value is said to be at 100. Bonds below face value, anything below 100 is at a discount. And bonds anything above 100 is above face value. So if I said that there was a bond that was issued at 102, you would know that that bond was issued at a premium because it was above 100. If I said a bond was issued at 98, you know that that bond was issued at a discount because it's below 100. The easiest journal entries are bonds that are issued at 100 because it's at face value. So let's look at bonds, the simplest example, issued at face value. Dever Company issues 100 5-year 10% $1,000 bonds at 100. So this is a little confusing because they're saying at 100, and that means 100% of face value. And they're $100,000, so to figure out total, we take 100 times the $1,000. So the journal entry to record the sale is Dever Corporation receives cash. We calculated that by taking the 100, the number of bonds. They're issued in increments of 1,000 to get 100,000. So we're going to debit cash and credit bonds payable. Now they were issued on January 1st, and they make their interest payment, you can assume, the following January 1st. So at the end of the year, we're going to assume that they have a calendar year. We have to make another adjusting journal entry to accrue interest. So we would take the principal, which is 100,000, times the rate that they gave us, which is 10%. And really, we don't need to use this 12 over 12. It's just because we held it for 12 months. So my journal entry is debit interest expense, credit interest payable, because we would pay it on the 1st of January. But let's say, well, this is 2017. This interest expense relates to 2017. That's why we need the journal entry. Okay, so then when they pay the interest payment, they would debit interest expense, credit cash. So important, I would write a study sheet of what are the journal entries when bonds are issued at face value? What are the journal entries when they're issued at a discount, at a premium? So we said that the simplest is when the contractual interest rate, also referred to as the stated rate, is equal to the market rate. And when they're equal, a lot of times they don't even mention the market rate because they're issued at face value. And that would be at that 100, if I could write 100 in here. When the contractual rate or stated rate is greater than the market interest rate, they're issued at a premium. When bonds are issued, a stated rate is 10%, and the market rate is greater than that, they're issued at a discount. Discount, remember, is anything below 100. Premium is anything above 100. So we want to make sure that we recognize when we're reading through the problems if it's issued at a discount or a premium or at face value. So let's look at the journal entries for a discount. Assume that on January 1st, 2017, Candlestick sells 100,000 5-year 10% bonds at 98. Okay, we know right away this is a discount, 98% of face value. So the cash that they're going to receive is 100,000 times 0.98. So they're going to debit cash for 98,000. We got to make our journal entry balance. So that initial discount, we're going to debit discount on bonds payable because for 2,000, because we have to pay back 1,000. So that difference is the discount between the 100,000 and the 98,000. I always would remember debit discount. That initial one is debit discount. This is how it would look on the balance sheet, and we would list our liability of bonds payable less our discount on bonds payable at 98. Now, here's a couple things to note, that when we're using what they call the straight line rate, we're going to allocate the expense to each period. For bonds issued at a discount, it increases the amount of interest expense reported during the period. As the discount is amortized, remember we're going to take that $2,000 and spread it over the life of the bond until its balance declines. The carrying bond will increase until at maturity the carrying of the bond equals their face amount. Okay, so that's important. So assume that candlestick bonds previously sell at 102 rather than 98. So now we're going to look at an example of a premium. We know it's a premium because it's above 100. So candlestick is actually, if we take 1.02 times 100,000, because they said go back to the previous example, we would debit cash for 102,000. We have to pay back or credit bonds payable for 100, and this premium on bonds payable actually reduces our interest expense. So here's how we would see this on our balance sheet. We would add the premium on bonds payable on the balance sheet. The bond premium is considered to be a reduction in the cost of borrowing. So if we look at our bond issued at a premium and we figure out our annual interest payment, we take the face value times the stated rate, and we would get 10,000. And we're going to pay this, it was for a 5-year bond, so that's really 50,000. The premium reduces our bond interest expense, and it was 2,000. So really our total cost of borrowing is 48,000 for those bonds issued at a premium. It's allocated to expense in each period. It decreases the amount of interest expense reported each period. As the premium is amortized, its balance declines. Okay? It's important that you understand what happens to the bond when they're issued at a discount, a premium, or face value. So in this chapter we talked a lot about liabilities, and so I just want to show you, if we were looking at our balance sheet, we talked about our current liabilities, and we could include in here sales tax payable that we had, and we also talked long-term liability. Generally speaking, bonds are a long-term liability. We would subtract the discount in this case, and we would add a premium. So hopefully this review will make sure, I would take some notes and make sure that you understand the bond terminology, things like callable, secured, unsecured, what those terms mean. Also that you know the journal entries. So if you were given a problem like Harper College issued 500,000, 8%, 5-year bonds at 106, you would be able to figure out what the interest expense was. You would recognize that 106 means that it was issued at a premium. So hopefully this review will help you. Make sure you take some time to write out the journal entries. I really think when you write things out, pen and paper, that helps you study. It's proven that there's a connection between writing it out and your mind remembering it. Thanks for watching.